When the bank underwrites the loan, they just figure out the interest that you got to pay on the loan relative to the value of the building or the income that it's generating. But all those ratios are upside down now because the value of the buildings, the rent has gone down so much because there's so much vacancy. I mean, when these loans were underwritten, San Francisco had like a 5% vacancy rate. And now it's like 30 to 40%. There are just no tenants. And then, in parallel with that, Jason, you've got all these cases where you don't only have tenants or leases rolling, you have loans rolling. Again, if the owner of the building has either a construction loan or like a long-term debt and that needs to roll, they have to refinance it. And if they can even get credit, which they may not be able to because of this crunch, they're going to be paying a lot more for it. So now all of a sudden, the income statement for that building doesn't make sense. Think about it. Your borrowing costs are higher and your revenue is lower. So now all of a sudden the building's underwater. So where does that end up? Well, they default on the debt and the bank ends up owning the building.